Get my screen set here. Yeah, so thanks everyone for joining. Today we're really happy to have Gale on from VITALIZE, who recently closed Fund 2. Gale's been a great partner of Visible for a long time in VITALIZE. A couple months ago, we saw a post on LinkedIn from Gale mentioning, hey, we just closed Fund 2. Happy to share this story with any journalists or anyone about the kind of my beliefs of the future of the LP landscape. And while we're not journalists, we certainly love creating content for founders and investors. And Gale is gracious enough to join us. So let's go through some housekeeping, and we'll bring Gale on in and get started. But yeah, today, like I said, I'm really excited to be joined by Gale. VITALIZE has been a customer of Visible since September of 2020. I looked that up today. So one of our first, I think, 5 customers of our investor product and platform. You can find Gale's Twitter and her LinkedIn here as well, and we'll make sure to send this out after. But yeah, it's been a tremendous partner of Visible, and Gale's content's great online. So if you're a first-time founder or fund manager, I would certainly subscribe. A lot of great transparent thoughts and content Gale has about all things venture. So make sure to check that out. And for those of you that don't know me, my name is Mike Pruce. I'm the founder and CEO of Visible. I'm going to share a little bit about Visible and a little bit about VITALIZE, and then we're going to go ahead and get started. Great. So VITALIZE, and once Gale jumps on here in a second, I'll make sure that we miss anything that I might not cover. But VITALIZE was founded back in 2018 and for its first fund, and now is on Fund 2. VITALIZE has over 70 investments across work tech and B2B2C companies with $42 million under management in total, 16 million in the seed stage fund and 23 million in Fund 2. Plus an amazing angel investing community as well, 500 plus members that I'm actually a part of. So make sure to check that out if you're interested in the angel aspect or learning more about angel investing. There's a lot of great resources and community that you can be part of with VITALIZE. So make sure to check that out. And then a little bit about Visible. Visible really serves 2 types of customers, founders and investors. We basically believe that great communication helps you raise funding. We started Visible back in 2015. We love serving founders and startups, and so being a profitable growing business has been a core belief and value of ours for the past 6 years. We have customers all over the world, like we just saw people writing in. And we work with a lot of great venture funds all over the world. VITALIZE being one, but we work with folks in France like Briga. We work with Emergence Capital on the West Coast, 01A, Forum. And so we're really proud with all of the different relationships we've built across the ecosystem. And we're going to go ahead and get started here in a second. Gale, how are you?
I'm good. Can you see me?
Yes.
Okay.
Awesome. So I introduced VITALIZE. I introduced yourself. Anything you want to make sure we touch on before we jump in?
I don't think so. Yeah, it's been a decade plus of doing deals, and then the VITALIZE timeframe, is in the last 6 or so years. So very excited to be here, Mike. We've loved working with his company, and I'm happy to share any sort of learnings that are helpful to you, the audience. So feel free to ask whatever questions that you have.
It's been an easy 6 years for you, right? It's been super easy building VITALIZE.
It's been ups and downs. I'm very honest.
Yeah. Great. So today we're all talking about Fund 2 and some of the learnings and really what the market's like. Just as a reminder, please feel free to leverage Zoom chat, Q&A, and chat. We either I'll try to play host and answer those real time, or we'll make sure we save some space at the end to answer those questions. This is being recorded. That's always asked. So we'll make sure to send this out after with the recap, and so you can review anything that we might have missed. And yeah, just please feel free to reach out to ourselves. We're always happy to chat and make sure you get the most out of this content. I'm just going to pull my Q&A doc over here real quick. Great. So yeah, today we're going to talk about kind of macro environment, VITALIZE, the recent fundraise for VITALIZE, some pre-fundraising activities that made a difference, how LP diligence has differed, from Fund One from Fund Two. And then also Gail's been gracious enough to share some of her actual content from her pitch deck that we'll review, and we'll wrap with Q&A advice, and we'll be on our way. Yeah, so this is probably not a shock for active fund managers, but maybe anyone that is thinking about raising a fund or is in the middle of raising a fund. You know, there's been clearly a big pullback in the market in the past year. I think it's since 2014, it's the fewest funds raised, and you can kind of see the amount of capital deployed as well. What's in the hearts and minds right now, Gale, of LPs? You mentioned that you have a lot of kind of thoughts, and I'm sure we'll weave in throughout this conversation, but you recently lived this. Like, what's on the minds of LPs, especially for, call it, early stage investors like yourselves, as new funds are trying to be raised?
I think we're going to see a lot of changes in the institutional LP landscape. So for those of you who aren't familiar, a limited partner in LP can be an individual, it can be a family office, it can be an institution, which includes pensions, endowments, corporates, and others. So historically, obviously, these institutions write very large checks, and that's the primary funding source of the venture capital landscape. The smaller that the funds get, then the more that you'll see family office investors and individuals, because the bite sizes are within reach of those two audiences. So when I have gone out, I just see there's a lot of hesitancy among institutional LPs to put capital into the asset class, period, but especially into new funds or small funds. I think what we're going to see going forward is a pullback in terms of total dollars going into VC from many of these large institutions. And the dollars that do go in are likely to go into the well-known funds like Sequoia, A16Z, and those that have the perceived proven track records. And then I think that with the early stage funds that are small, so let's say sub $50 million funds, I believe we're going to see a lot more retail investors, which is another word for individuals, stepping in to be the primary funding source for those GPs raising that size of fund. And the interesting thing is there's actually some legislation right now on the table in the Senate. There is bipartisan support, and we should at some point this year see the limit of LPs increase from 99 to 5 to 600, which means that smaller funds up to 50 million will be able to have a lot more LPs for smaller bite sizes, which is a really good thing for individuals. And it's a really good thing for founders, because I think that these retail investors are going to kind of save the small funds, so to speak, even when the institutional LPs leave the sector.
What have you seen from retail investors in that same time frame, right? Like, retail investors theoretically have been impacted by some of the same macro things and are attracted by basically 5% risk-free money in a savings account versus maybe putting that into a new venture fund. Like, has that changed as rapidly as institutional, or maybe not as affected as much as you were raising Fund Two?
I mean, I might not be the right person to ask this, because I've always worked primarily with individuals. And so if I think back to it took me about 2 years to raise the fund. There's definitely cyclicality for individuals in terms of what they're putting their capital into at any given point in time. So obviously the market had been doing very well in 2021, 22, and everybody felt, quote, rich. And when that happens, especially when you're in a hype cycle like we were in with venture, and all this stuff is moving really fast and there's FOMO because you don't want to miss out on it, we just saw a lot of individuals pouring money into the asset class, whether it was direct into companies, into funds, or also into what are called SPVs. So these are special purpose vehicles, which is effectively a fund for one investment. Fast forward to about April of 22, we started to see somewhat of a slowdown. And then into 23, very much a slowdown in terms of individual activity as folks felt more, quote, poor on paper and in their investing accounts. What I perceive will happen going forward is that now that the stock market has started to pick up, and we believe that the interest rates are going to come down towards the end of the year, I think we're going to see kind of a resurgence of some investment by retail investors this year, even though not likely at the levels that we saw a couple of years ago. But the difference here is that there's going to be more people at the table, I believe.
Yep. Amazing. Awesome. Thank you. Before moving on, Jen has a great question we can just answer live here since it was mentioned about the number of LPs increasing from 99 to, you mentioned, 5 to 600. Curious, it sounds like it's bipartisan. Any inkling of when that might be enacted? I know you don't know, but is it like, does it feel like months or years?
I mean, I would assume by the end of the year, but a bill like this could get pulled if other things are perceived to be more important. But the good news is that there's both a Republican senator and a Democrat senator that are behind the bill. And when that happens, like the odds of it going through are quite high. So that's really good news. And the folks at the Center for Entrepreneurship have been working really hard on this. So I'm very grateful to them because I do think, and it seems like a small bill, but I think that this is going to truly save the early stage founding and funding environment.
Yeah, awesome. Thank you. And then just timeline. You mentioned it took you. It sounds like 2 years from start to close. Clearly with kind of the inverse happening, right? Not as much being raised as it take longer to raise. How did this map to maybe what you planned for Fund 2 versus what actually happened? Were you gearing up for thinking this is going to be a 2-year raise, a 1-year raise? Like how did that map to the reality?
It was not what I expected for sure. My first fund was a $16 million fund, and I raised that in like 3 months. And so to only raise another 7 million, and it took me 21 more months, the math is not good on that. But I got caught in what everybody was telling me I should do. So all the LPs and other GPs and advisors that I was talking to would say things like, okay, well, you've got your one fund down, you've made really great investments, you have your story, you have your focus, you have all the building blocks, you should go out and raise more money. And we as institutions expect you to at some point get to a place where you have more than $100 million fund, because that's kind of the minimum required for institutions to place capital into these types of entities. And along with that, as you raise more money, obviously you have to write large checks. And if you stay at the same stage, which ours is seed, we would have to lead deals. And what that means is today, when we just co-invest and we fill out rounds, is very different than leading. And so I found a lot of friction out there where the institutions would say things like, we don't know if you're going to be able to win these deals. But at the same time, like, we really do think that you need to focus on a percentage ownership strategy and try to do fewer companies. And so I had hundreds of these conversations, and I kept getting some flavor of the same feedback, which is effectively, we expect you to do what everyone else has done, but we really prefer to invest in somebody that has more of a track record or that's spun out of a big fund, and we believe that they have access to the same deals that big fund has. Over time, I realized, what, this is not a good fit for me personally and for our firm, because we've always been very good at individual investors, doing SPVs, doing angel deals. And my fund one had pretty much all individuals, maybe a family office or two. And I absolutely love working with individuals. These are oftentimes entrepreneurs themselves or entrepreneurial, and they just love it. It's a very different personality oftentimes than what you see on the institutional LP side. And so I said, okay, I don't want to raise 50 million, which is what I set out to raise. At the time, I was already at like 20. And I think it makes more sense for me to stay closer to that 16 million that I had last time. So let me try to raise 25. So anything between 20 and 30 works for us to be a co-investor rather than leading deals. And we could do our same strategy that we did in Fund 1, which worked really well, which is a lot of bets. And the thesis is you just really want to get into the good companies, and the more shots on goal that you have, the more likely that becomes. And because I've built a co-investor network of 850 plus people in the last decade, I get calls all the time with really amazing deals. I think that is, career suicide if I give that up. And so I decided right then and there, like, let's not do this. I checked with our team to make sure that Caroline and Annette were on board, and we all were very much in agreement that every 4 to 5 years, we're going to be raising a $20 to $25 million fund. We're never going to get bigger than we are. And this allows us to continue to do the same strategy again and again. And we're already good at it. We've already proven it. So we're not going to have to do what a lot of funds do, which is shift around. And so the learning here is try not to listen to what other people are telling you. And I think the most successful fund managers are going to be the ones who are really authentic to what is important to them and how their model, every attribute of that model really reflects that authenticity.
Yeah, I think that's spot on. When anything you're building, like focus and staying core and true to what you believe is such a huge driver. At what point in that process did you decide we're not going to listen to all of the quote unquote conventional wisdom because it's conventional, and decide to change strategy and fund size? Was it early on? Was it halfway through, towards the end? Like at one point did you have that kind of aha moment?
It was probably at halfway point or a little after that.
Okay, awesome. Great. Well, we'll get to some more of that too once we get into the deck, into the story. Anything else you wanted to mention, just as it relates to, call it, just the time it takes to raise, that you wanted to touch on?
A lot of times when we see the announcements of funds being raised, it seems like they were probably done very fast and it was very easy. And almost every single emerging manager raising funds 1, 2, and sometimes even 3, it takes at least 2 years. So just for those of you who are raising funds, I would go out expecting that it's going to be 2 to 3 years to raise your first fund and probably your second fund, unfortunately.
Yeah, good. I think expectation, same thing for founders, right? I think a lot of times we work with a lot of founders and there's an idea that you can get it around done in 2 to 3 weeks. And the reality is that, it takes months to actually be successful at raising capital. And especially now it's much longer. It's really no different.
Yep.
Great. Let's move on. Kind of talking about your process and how you tackle this process, and just some numbers that we pulled to share. And please feel free to correct any of this. But $23.4 million raised. Took about 24 months from start to end. Hundreds of first meetings. 77 total LPs with an average check size of 300,000. And you're anticipating, call it 30 to 35 portfolio companies. We're going to break down kind of what went into this and some takeaways. But maybe my first question for you, Gale, when did you decide to raise Fund 2? Like we know it sounds like it took 24 months, but was it because you had a really great portfolio and you're like, yes, let's go raise Fund 2? Was it existing portfolio companies? Was it positive signals from existing LPs? Like, what was the moment you were like, yes, we're going to go raise Fund 2?
I don't know that I was even that strategic about it. I think I just assumed like we would just raise Fund 2, which is not probably the right thing to do. Luckily, we do have, I think, what is going to turn into a very successful Fund 1. And I'm somebody who's always looking at the data and tweaking things and trying to get better. And so if I look back to 2017, 2018, when we started Fund 1, I have learned so much and made so many mistakes that I've really changed a lot of things. Like we were a generalist B2B fund, and now we're very focused around work tech. And, I think that we want even more at bats than we had in Fund 1. And I think that we did too much follow-on investing in Fund 1. So I knew that we had learned so much, and we were already pretty good at picking these companies, and we have great sourcing and we have great, expertise in this space that we're focused on, that it just made sense to raise another fund. And the way that I'm going to think about it in the future is twofold, just in case this is helpful to anybody. I've told my LPs, and I'm very open with pretty much everybody, but especially my founders and my LPs who are stakeholders in our firm, that as long as we can 3x net the capital that we take in, which corresponds to a top 25% performance, we will raise again and for 4.5, 5 years as that deployment period from the last fund is done. And it takes a couple of fund cycles to get to that point, because by the time that we go out to start raising Fund 3 in 2 years, we should have some good performance data and understanding of where Fund 1 is going to end up. So I'm very focused on, in the future, we'll only consider raising a fund if our performance continues to be strong.
Yeah. Awesome. Thank you. So yeah, let's get into some pre-fundraising activities. Maybe starting with nurturing relationships uh, with your LPs. You mentioned, over 850 plus co-investors and people you've done deals with. So it sounds like, and I know you have a big following on Twitter and LinkedIn. So it sounds like you have a large established network that you've cultivated over the past decade. As it relates to kind of Fund Two. Let's just kind of talk about nurturing some of those relationships. Like, where did you find LPs, Fund Two, both like current and maybe net new LPs? How are you nurturing them along the 2-year close, right? From people that might have committed day one to close, and like how often were you communicating with those potential LPs as you were closing Fund Two?
I do most of my communications, whether it's founders or LPs, on a quarterly basis. When we had Fund One and its deployment period, we sent quarterly updates. And we still send those. There's not as much interesting stuff going on in Fund One at this point because there's not as much activity, but we'll still send quarterly updates that I think Mike's going to walk us through our tear sheet, but we want to make sure that they understand how each company is performing and then what our sentiment is on the overall market and how the outlook of our fund it fares at this point in time. So we actually show kind of a grid of where we expect our companies to fall in terms of returns from a cash on cash perspective. Like there's a column for 0 to 1x, and then there's a 2 to 3x, and then there's a 3 to 5x, and then 5 to 10 and 10 plus. And after a few years, you can really slot them across that grid in terms of where you think they're going to go. Because I think that's what investors really want to know is how are these companies doing and when do you think we're going to get exits? So now that we're in the harvest period of Fund One, I spend a lot of time thinking about working with the companies that still have positive exits on the horizon. For a prospective LP of Fund Two, when I was in that process, I still was reaching out on a quarterly basis. I also have a list of 375 people that are watching me for Fund Three. So they get a quarterly email where I share information on how Fund One and Fund Two are doing and any interesting press, anything that effectively just proves to them that we're doing what we said we were going to do and that we are organized and we have our crap together enough to send these updates. Like those things are really what's important when you're nurturing the relationships for future funds.
For those, call it 375 potential Fund Three investors, are you sharing like the same level of granularity you are with the Fund Two, like current investors, or is it higher level kind of highlights like more broad strokes of portfolio performance and like maybe just like mentions of new investments, maybe without all of the specifics and details?
Exactly. Yeah, we can't share company specifics with prospective LPs because I don't really want the company's information to get out. So the prospective updates tend to have a TLDR, an update on fundraising, update on new investments, an update on any sort of traction that we've gotten. So if there's an up round from an existing investment, if there's an award that someone on our team has won, or we've been on a podcast, or like something that is interesting that these potential LPs like might want to click on this webinar with Mike and Visible just to kind of hear how we think. This is the stuff that we're collecting and putting into a summary form so that they can just stay up to date in terms of how we're doing things.
Yeah, awesome. Yeah, you mentioned the tear sheet. So this is a real example actually of the exact tear sheet that you are sharing with your existing LPs that we helped produce at Visible. We actually built this more or less with VITALIZE from the beginning to help shape this feature. We've obviously redacted anything that might be sensitive here, but curious, Gale, like how has this worked for you as you're communicating with current LPs? You mentioned a lot, if not all, are retail investors. Are they jumping in and assisting with your current portfolio companies? Yeah, what does that communication look like with those current LPs as it relates to the function of this tear sheet here?
This tear sheet was created to try and find the right balance between giving the investors, the LPs, enough insight into how the company and the portfolio are doing while not being too cumbersome for the founders. And so once again, I've been in this industry for now 11 plus years, and I tried a lot of things early on. I had a lot of investors who said, hey, I want to see monthly numbers. I tried to get that. There's no way that's happening. They wanted more data. We want to see budgets, and we want to see margins, and we want to see customer lists, and we want to see all this stuff. And it's like, that's too much. And so after we tried a lot of different things, we settled on, okay, at a base level, we want to understand revenue by quarter. We want to understand the expenses for that quarter, and then their cash position, because the things that we're looking for are, is your revenue growing fast enough? What's your net burn looking like? So are you spending too much cash or the right amount of cash? And then finally, with your cash balance, how much runway do you have? And when they get below 6 months, we always reach out to those companies after we review these tear sheets to just have a conversation with them and see how we can help them potentially raise more money. We always share kind of key updates with our investors. And this is like just really kind of the fun stuff. What are the key wins that these founders are having? And a lot of our founders also ask us for help with hires or customer intros or strategic advice. And we list 1 or 2 for each of our companies, and we try to be as specific as possible about those asks, such that our LPs will hopefully pick one each time and make an intro for our companies.
I would like double down on that real quick, because that's the same thing for founders, in case there are any founders, but it's certainly investors as well. Like, the more specific the ask, the better. Like, saying something general, like looking for help with raising the next round, will elicit almost no action, versus being very specific, like, hey, this founder is looking for an intro to Sequoia. Do you know anyone on the crypto team? Because that's gonna like elicit very specific feedback, and if you get one person helping, that's better than none. Same thing with founders. We talk about that all the time. So I think that's super smart. I just wanted to plus one that comment, Gale.
Good.
By the way, you're like way ahead of the curve on this, because like, you know, call it 2020 to last year, people really didn't care about revenue and burn and that. So it's been cool. Now it's cool. So you're way ahead of the curve on.
So hold on, I have to ask. So does that mean that we were kind of seem to be over the top when we asked for this? But then are you able to sell these tear sheets to other clients now?
Yeah, for sure. When it comes to like operating metrics, like cash revenue, OpEx, some of that, you know, those metrics, I think certainly almost all of our customers are collecting that data. I think it's a lot of prospects that have now come back and said like, hey, this stuff actually really matters to me. Because I think a lot of people were caught surprised in the past 12 to 18 months with cash position and burn and some other things, because we got everyone thought they were really great investors, and all companies were doing great because of the markups, and less, call it, thoughtfulness when it came to simple financials. So you've just been ahead of the curve on this one, which is great.
That's right.
In terms of diligence, so kind of getting further down, you know, we've talked about finding where you found your new investors, how we're nurturing them, getting to the diligence. How did diligence change? Did it change from fund 1 to fund 2? And what the metrics that LPs care about? Especially let's talk about retail, because it sounds like retail and individuals, it's kind of your zone of genius. Like, what are you seeing those types of investors care about? Maybe that's a little bit different than an institutional LP.
Individuals, I believe, care about a few things. But before they even weigh in on that, there have to be 2 things that are true. And the first is that they have money set aside to invest in some kind of alternative asset class. It has to be like in their mind, okay, I have money ready. That's number 1. If they don't have that, you're never going to get a check from them. And it sounds basic, but there are a lot of people who take meetings who don't have that. Mm-hmm. And then the second piece is, do they like something about what you're doing? And it really, this is where things start to vary. They might like where you're located. They might like your industry. They might like your performance. They might like some attribute about your total story. It has to resonate with them personally. So that is the second thing that has to be true. And from there, I think that individual LPs are reviewing your stuff just to make sure you have, your stuff together. And at the end of the day, they will invest if 1 and 2 are correct and they like you. So after you have the call, if they believe that you're competent, they feel like they would want to work with you for a while, they trust you, they think that what you have is something interesting to them, that's when they'll make the commitment. And so that's another reason why we love working with individuals, because they can make these decisions quickly. And, just how I think about investing in founders, I'm listening for those things. What's the passion level of the founder? What's their business model? How are they going to execute on this? Are they organized? Do they show up on time for meetings? Do I like them? Can I see myself working with them for 10 years? It's the same thing that individuals are looking for with fund managers too. I do think it's very different with institutions.
What about it's a relationship game. It's a relationship driven business. You mentioned that they have to like you. When do you tease out the question, do you have money to invest in alternative assets? Is that, upfront right away, the first thing you're asking, or when does it make sense to try to naturally qualify that investor without, call it, burning the relationship or being off-putting?
A lot of how I have met individuals is through kind of cold outreach or asking for intros from somebody that I know. And I think there is some art in your message that you send out. And in the message, I'm very clear about who we are, what we've done, and what we're looking for. And so when I list that, minimum investment amount, I expect that anybody that takes that call fits that. Now, when I'm actually on the phone, if I can tell that they're a serious investor, they're going to ask certain questions, and the rapport is going to be, very consistent with what I've seen before. If I'm on a call with somebody who obviously wants something else, like, I can't tell you how many have taken calls with me because then they want to pitch me their startup, which really ticks me off. I end those calls like, thank you so much. It's not a fit, but I wish you all the best. And I'm never mean to them, even though they're wasting my time. I think I don't want to burn bridges, but I also have to be really focused around what I'm looking for. And if you ever feel like something is off in that conversation, absolutely bail, because you don't know that person anything.
Yeah, awesome. I think that's a thing we've heard with a lot of our guests over the past year for both sides. If something just feels a little bit off with the relationship, it's totally acceptable to bail and not continue, because your gut is actually just trained on intuition or trained on past experience. So that makes a lot of sense. Let's jump into the deck. I think we have 3 or 4 sides kind of showcasing some of the things that you use to raise your fund 2. But I'll let you kind of take it away from here, Gale, in terms of what you want to hit on. But maybe just some questions to get us started. Kind of the basics, like how many slides were in this deck? What parts did you find LPs cared about the most? And then kind of what role did this play? Was this to get the initial meeting? Was this a talk track during the meeting? Like, what role did your deck play for helping raise fund 2?
This is a 10-slide deck. This is the last iteration of the deck that I had when I stopped fundraising in October. I probably had hundreds of iterations of this deck, and some of them were dramatic changes and some of them were incremental changes. What I learned over time is that back to, do they have money? Do they like something about you? Being kind of the precursors to that last question, which is, do they like you? I realized that I have to qualify that second piece when they review the deck. Do they like something about what I do? So I think most decks are way too long, that a lot of GPs have. And you have to really figure out, what is it about your story that's interesting, and give enough information to make it extremely clear who you are and what you do without going into any sort of, confidential information. So like, I've blacked out a few things here, just like there are some performance numbers. since I'm not sure how many people are going to see this, but when I reach out to somebody, I would link to this deck, and they can go in and they can see what our high level performance is. They can see who's on the team, how long we've been in VC, kind of what we think our bread and butter is, or our competitive advantage. And then, the goal really is, after they review this deck, that they want to learn more. And that's when they would have a call. So I always think it's helpful to send out something beforehand, let them review it. And then if it's a fit, have a conversation where I'm not even pitching the deck. I'm just answering questions that the investor has for me. And I'm trying to get to know them, because I have to vet them as much as they're vetting me.
Yeah. Awesome. Kind of moving on to what you focus on and why. The why me, I think, is so important. Do they like me or my story? How did you leverage this? And it sounds like from fund 1 to 2, you've learned, call it agnostic B2B SaaS to more work tech. How did these 2 slides here play a role in the fundraise?
Yeah, I made the decision to get more specific about what we invest in, because in 2012, when I started investing, there were 30 seed funds, and today there are 3,000 to 4,000. So if you think about what that means, LPs are seeing literally hundreds of decks, assuming that they're being found by GPs. And my $25 million fund is very similar to pretty much every $25 million fund out there, and probably a lot of the 50 millions and probably a lot of the 15 millions. And so we have to think about, getting really specific about what we do and why. And we picked work tech because we'd done a lot of investments in it. We're personally interested in it. I had started 2 businesses in it before. And you also want the stuff that you do to be fun. And I think work tech is the most fun aspect of B2B software, because we, as people, are the end users of a lot of it. And so it's the most consumer-like in the business world. And so what we wanted to do is really define work tech. We played around with future of work, and then we called it work revolution. And I will be honest, a lot of investors were extremely confused about what this is. And I realized that it's just such a new concept that we had to come up with our own definition of it. And we landed on work tech. And so we invest in 3 things: enterprise software that transforms workflows. We do the freelance economy infrastructure, because we're very bullish that that part of the economy will continue to grow. And then finally is kind of what your traditional HR tech is: hiring, recruiting, learning and development, and so on. The interesting thing about work tech is that a lot of LPs would dismiss it as, oh, that's not really interesting to me, because they immediately think, oh, you're just looking for Slack and you're looking for the next Zoom, and that stuff's played out. But the way that I think about it is, I'm looking for massively revolutionary ways to transform how we work. And it's already, as you can see in the slide next to it, it's a huge industry. So you want to have some kind of data around how big this opportunity is, and share any background that you have, like my 2 startups, that make it very understandable why you're going after this particular space.
Yeah, you can even hear it in your voice why you're excited, which is great.
Good.
And you mentioned, the competition out there. I think you, Gale, do a great job of leveraging social and your platform for your brand and VITALIZE's brand. How much of that is part of the strategy that you use to fundraise? How much do you think it needs to be part of a strategy, right? I think there's a lot of potential GPs or GPs on this call or part of our community that have no social presence. So, talking about the connection and platform and some of the things you mentioned here, and the role it played in Fund 2.
The number one piece of feedback that I got from everybody during this fundraise, other than you need to raise more money and you need to, you need to invest more per deal, was you have to prove to me why you're different. And I think that this is where a lot of GPs get caught up. I mean, I was on a podcast yesterday, and the question was asked to me by the host, how did you do this? A lot of our listeners want to replicate what you've done. And I said, don't try to replicate what I've done. I started a university affiliated angel network back in 2012 when hardly anything like that existed. And I said, today, I expect models that are truly novel, that haven't existed before, to be the ones that win. And so whereas I did this angel syndicate and I eventually raised a fund off of that community, today what I would probably do is find an operating role at a startup in a space that I love. And with the blessing of my manager there, go and start a small fund on the side, 1 million, 2 million, 5 million bucks, not very big, something that I could manage by myself in my free time. And that would allow me to start to build my network, both of investors, of deal flow, and I would be getting some money from my job and learning as having that operating role in the industry that I care about. So like, I actually think we're going to see a lot of these kind of hybrid roles coming down the pipeline, which is a really, really good thing. Like, I think we will have tons and tons and tons of small funds. And what each of those fund managers needs to do is figure out, like, what is my network? How do I find them? How do I engage them and get them excited about what I'm doing? And how do I build deal flow? And how do I get operating experience? And how can I become the expert in this one thing that I love that I'm going to become synonymous with because it's so much part of my personal brand? Like, that's how I would start today if I were doing this. And I did not spend any time on my personal brand for 8 years, probably. And that was the biggest mistake that I've made. So for those of you who are not doing anything for your personal brand and you want to be in venture, I will tell you right now, you won't make it. So you have to figure out, do you want to do a blog, podcast? Is it LinkedIn? Is it Twitter? Is it Instagram, TikTok, something else? I don't care. Pick one thing and figure out what your brand is. So what do you want to be known for? And start to figure out how you're going to write content and do one thing a day. And then, you're going to tweak that over time, but you have to get information out there so that people can find you, because this environment is only going to get more crowded.
I'll leave it at that. I think that's great. Deal sourcing. I was literally on a call with one of our potential customers yesterday where they mentioned, like, hey, we want to use Visible because we want all of our time of our investment team and our team for helping source new deals. What level of importance do retail investors place on deal sourcing? And like, anything you've learned throughout your career so far about finding successful deals, where they come from, and how did that play in your story for Fund 2?
Deal sourcing is definitely important. All LPs are going to ask you how you find deals. I actually think picking deals is more important, but we can talk about that later. From a sourcing perspective, you just want to understand where your deals are coming from. So for me, back to that 850 person co-investor database that we have, we've just been, very lucky to have a lot of investors create, great relationships with us, and they like working with us and we like working with them. And we've spent a lot of time on the people side of the business. VC is not really finance business. It's a people business. And because of those great relationships, we source awesome deals, and they already have other investors, and we're able to bring our expertise to the space within that entire round. I think from a picking perspective, this is where it gets a little bit more challenging, because if you have good deal flow, you can't do all of them. And how do you pick? Because what you want to make sure of is, in your portfolio, whether it's 10, 15, up to 35 companies, you need to make sure that you're investing in really good stuff. And I think that's part of the magic of all this. And it's really hard. It's hard to say how you do that or why. And this is something that I'm constantly kind of working on, because that's where the magic is. Like, I've gotten in front of so many good companies over the years that I have invested in, that I haven't invested in. The good news is I'm seeing good deals, but to maximize returns, I have to make sure that I'm picking well.
Yeah. That's a whole conversation probably for another day. I want to make sure we have a chance to get through some of our final slides and the couple questions that have come in that we have, and want to get to those too. So the terms and asks are laid out here of Fund 1 and Fund 2. Pretty similar. The one kind of question I had, and you mentioned this earlier actually in our conversation around follow-on. What has been your learning around? You hear so much of the importance of follow-on and reserves, and it sounds like you might have had a learning or an aha moment where you've changed from, call it 40% follow-on to theoretically less than 20 in Fund 2. What was the reason for that change?
If I look at data from the deals that I've done historically, I am very, very good at first check picking. I am okay at second and third check picking. And if you think about what that means, when I invest with first checks, I'm investing at the seed stage. When I invest in a follow-on round, it's now the A stage, and a follow-on of that is now the B stage. And I'm competing against investors with a completely different skill set than I have. And I think one of the biggest changes that I've made in the last several years is just like, what am I really good at? And let's be honest with about that, and let's lean into it. And so what we want to do is write more checks, not worry about follow-ons. I tell founders that upfront. It's on our website. We don't do follow-ons typically. And if we do have a company that does, amazing stuff and they really want to work with us again, we have a network of a couple hundred folks. So we can do an SPV or one of those special purpose vehicles to take the follow-on from that. But we know in our fund, it's all first checks, and we're never investing more than $750,000 per company. And honestly, that takes a lot of pressure off of me as an investor to try to pick and choose. And you've got all these founders that really need capital. And so how do you pick? If I was a GP that was doing 10 to 15 companies and I'm getting a huge percentage ownership, 20, 25%, I'm on the hook. It's my job to keep that company going. And me as a co-investor, I'm here to help in every way possible. I'll intro you to other VCs. I'll intro you to family offices and strategic capital. I will help you with your strategy. But I have made it very clear that I'm not going to be the one that bails these companies out. And I really push our founders when we have the initial conversations. We're looking for founders who can get on the revenue growth train really fast and stay on it. Because my pattern recognition looking back, those are the founders that make it. The founders that are stuck between $1 and $2 million of revenue, and they need more capital, and they need more capital, and they need more capital. I'm not interested in that, because I've seen it time and time again, and it just doesn't ever work out. I want to reinvest in the ones that are going like this. And so for those that are going like that, that's where we'll do the SPVs.
Just pure curiosity on my part. You mentioned with Fund 1 right now, you're sharing kind of a scorecard of cash on cash expectations. Some of that to me is kind of related to follow on of where you think these companies might end up. Have you ever seen an example where companies that you thought might be 5x are now 0 to 1, or vice versa, 0 to 1 are now 5x? Because to me, that's kind of related to maybe follow on decision making. Does that matrix change dramatically over the years, or has it more or less kind of stayed true?
It primarily stays true if you have a good handle on what's happening inside the business. However, there are definitely deals that I have done where I wrote them off in my head. I'm like, there's no way that this is ever going to make it. And my number 1 and 2 top performing deals of my entire career, I almost wrote off. So you never know. I've also really thought that I would make a killing off of one of my deals that they were going to get acquired, and it just fell apart, and they had to do a fire sale, and I made nothing. You just never really know until you get to a point where there's a liquidity event. So I don't see a ton of drastic movement over time. It tends to be fairly stable unless you have some kind of weird shock. On those first 2 that I mentioned, our founders there did not give us a lot of information. I thought they didn't have a shit together, but later I learned that they were really doing a lot of work and killing it. Whereas, sometimes the opposite, where things seem to be going really well, but the founders kind of hidden the fact that they're spending way too much money, and they've gotten out over their skis, and they've been trying to hope or wish into existence a really good story. And a lot of founders do this, and it's so frustrating as an investor. I wish founders would just be so honest with me about what's going on, because I can help them. I can't help you once you're down to 6 weeks of cash because you were just praying that this capital would come in. Don't do that. That's the worst thing that founders can do, but a lot of them do it because they don't want to admit that they're failing.
Yep. Great. Let's wrap up with some Q&A. We got the appendix here. We kind of talked about predictions for capital already, which is great. And we'll get to some Q&A. So let's go with Nathan first, who wrote in on the content piece. You mentioned how kind of GPs need to be some sort of branding exercise. Color on what resonates. Is it more general VC advice and trend analysis, verticalized insights into work tech. Like, where have you found maybe your niche, Gale, and how does that maybe translate to how I should be? Clearly, I don't want to copy what you're doing, but like, what have you learned now doing this since you decided to make a very intentional brand for yourself and Vitalize?
I would try and answer this question for yourself in the following way. Go online and try to find personal branding exercises. Like, you can do 360 analysis, and you can go out to all your friends and you can be like, okay, what kind of dog breed would you say I am and why? Or what kind of cereal brand would I be and why? And these types of exercises will give you a ton of different data points, and you can start to see, if you send that to 100 people that you know, they're going to give you their feedback of how they perceive you. You might like what comes back and you're like, oh yeah, that makes sense, I'm going to lean into that. Or you might be like, ooh, I don't like that. So that's one piece of it. How do people already perceive you? And then there's the, what do you want to be known for? And this is where it's just a whiteboard, and it's completely up to you how you define your North Star. Do you want to be known as a teacher, and where you're sharing, like, here's how to raise a fund, or here's what you should do, founders? Or do you want to be somebody who's known as an advocate for DEI, and you're really sharing ways to help, you know, underrepresented founders do well? Or do you want to be somebody that is, you know, trying to build an expertise in a certain vertical? Or there's VCs out there who will write stuff that's contrarian. Like, there's all kinds of ways to do this. I think mine, when I came up with this a few years ago, was it's how to angel invest. It is general insights for founders that I see in my day-to-day that can help them. And then the third piece is I will sprinkle in here and there ways in which I can help underrepresented founders. And the final kind of rule that I had around my own personal brand was to always be positive. So I probably need a refresh, to be honest, because you should, you know, that was in 2021, I believe, when I kind of first set that up. But we're constantly evolving. So it is a great exercise for everybody to do every year or two.
Yeah, awesome. Mike just wrote in, did you get raise any capital from fund of funds or from RIAs?
RIAs do not like VCs because they do not want their clients' capital going somewhere else. They make a percentage fee on assets under management that they have for that client. And so, like, there's usually oil and water when you think about VC funds and RIAs. For those of you who don't know, RIA is another term for like a wealth manager. So I talked to a number of them. It never went anywhere. And if you talk to a bunch of VCs, 1 out of 100 will find success with it. So I would not waste your time on it. What was the other one, Mike, that they asked about?
Fund of funds.
Fund of funds. Yeah. So fund of funds is a great place to raise capital. You just kind of have to find one that actually has money to deploy, because a lot of LPs don't want to invest in fund of funds because they have double fees. So I really hate that. I wish more big pensions and endowments invested in fund of funds, because, you know, that should be the primary source of GP capital, but unfortunately it's not.
Let's see, I'm gonna read this real time. When it comes to LP diligence, have you found a specific tool or best practice to vet LPs to expedite the process? Or is this something you do pre-outreach based on your current network and database you built? I know we touched on all this, but I think this is a great question.
Honestly, anybody who I think has enough money to invest is in my consideration set. Like, that's just kind of honest.
Yeah.
I think that if you can find affinities with people, hey, you're also located in Chicago. Hey, you also went to the school that I went to. Hey, you also were in this industry that I was in. Like, those are the things that I think increase chances that you'll get somebody to convert into a meeting and later potentially into an investor. So I think there's ways you can strategically try and segment the folks that you're reaching out to. But at the end of the day, I would, if anybody from this webinar was like, hey, I've got, you know, money to invest and I want to talk to you, be like, great, let's have a conversation.
Awesome. Is Fund 2 closed? I got a lead for you. Is it closed? I'm looking in chat.
I do have one LP with some health issues who has asked to reduce his $1 million stake to 500,000. So actually, and I told him I'd help him because I love this person. So I do have 500,000 that is available.
All right. I got the email sent to you after, Gale. Thank you, Joe.
You're the best.
And then let's wrap with kind of one question from Ben here, and let me make sure I got the rest. Yeah, well, we'll wrap with this one question, two questions. Second to last, how much we touched on when you decided to raise Fund 2, which was I thought I was always going to do it. There wasn't much of a framework. Are you willing to share like how much cash was distributed to LPs from Fund 1 before you raised Fund 2, or maybe not a specific number, but a percentage? We'll call it realized or paper turns. Like, did that play a factor at all in raising Fund 2?
The data that I just saw from Cambridge Associates for my vintage is 2018 for Fund 1. I believe the top 25% was something like 0.15 DPI, and that means distributions paid out to the investors. The top 10% was something like 0.3, if I'm remembering correctly. So it's still very low for the 2018 vintage, and ours is, we have a little bit on the books. It's not quite at the top 25% level, but we're at the point now where we've had 3 exits that are small. We recycled some of that, and now we're starting to return capital. So anything that comes in from here on out, we'll be returning to our investors.
Okay, awesome. And then final question, outside of the time it took to raise Fund 1 versus Fund 2, any other major differences you noticed in the landscape or just in general between the two different vintages?
I think a lot of GPs will tell you that Fund 2 is their hardest fund to raise, and it makes sense. Whoever just asked that question, you're asking the right question about DPI, because that's what matters at the end of the day. Am I returning capital? And I'm very, very serious about being a good financial steward for all of my LPs. And it's always top of mind for me. But I raised Fund 2 when Fund 1 is still very, very new. And I'm not going to have that much DPI, if any. So that means that these investors, and many of my first fund investors, back me again, which I'm so grateful for. They are really betting on me and my team to be able to produce returns in the long run. So it's a hope and a prayer on Fund 1 for sure, but there's still this dream of getting into these great companies. And Fund 2, the LPs can see exactly what you've done, but there's also this question of like, okay, well, now you really have to show performance because you've got stuff on the board. And I really feel like before Fund 3, like, I really need to have stuff on the board. And once again, I won't raise again unless I am very clear on my belief and being able to make not just my LPs money, but myself money, because I have like 50% of my net worth in my funds.
Yeah. And like you mentioned, you're not trying to raise a huge fund. So it's,
No.
you ain't getting rich off of management fees,
No.
right? So...
No, I do not have a big salary.
Yeah. Okay, great. Thanks everyone for the great questions. Please feel free to reach out to myself or Gale with any follow-up questions. Gale, thank you so much for your time with your partnership with us and sharing some of your learnings with everyone here. Appreciate it. And we'll see everyone soon. Thank you so much.
Awesome. Thanks, Mike.
See ya.
Bye, everyone.